A pretty substantial part, or perhaps all, of the overshoot in inflation comes from categories that are directly affected by the reopening of the economy, such as used cars and trucks in particular. There's sort of a perfect storm of very strong demand and weak supply due to the reopening of the economy and various factors. We see airplane tickets, we see hotel prices, we see other things. Those are things that we would look to stop going up and ultimately to start to decline as these situations resolve themselves. They don't speak to a broadly tight economy and to the kind of thing that has led to high inflation over time. I will say that these effects have been larger than we expected, and they may turn out to be more persistent than we've expected. But the incoming data are very much consistent with the view that these are factors that will wane over time and that inflation will then move down toward our goals, and we'll be monitoring that carefully. Of course, we're prepared to use our tools as appropriate if that turns out not to be the case, to guide inflation to 2%. Specifically on inflation, you're really talking about consumer price inflation, the CPI. We actually use at the Fed PCE, personal consumption expenditure inflation. And that the basket is actually updated on a monthly basis for PCE, and that's one of its more attractive features from our standpoint. Still, at a time like this, when people are changing their consumption patterns in ways that are outside of experience, I would say there's also a challenge there. Even though our measure is in fact updating monthly in terms of its basket. A significant number of people still report themselves as not wanting to work because of being afraid of being infected or being afraid of carrying the infection to somebody they may live with who's vulnerable. Also, schools not being open, that's weighing on participation by caretakers. And also, the unemployment insurance may be interacting with some of those other factors and causing people to go on with their job search longer. There's another thing, though. The very quick job gains of the early recovery essentially involve going back to your old job. That's not so much what's happening now. Now it's actually finding new jobs, and that's a matching function that is more labor intensive and time consuming, and there may be a bit of a speed limit on that.
Why are the jobs numbers so bad right now?
Well, I think we're digging out of a very deep hole. We've made a lot of progress, but I would agree with you, we have a long way to go.
Over 9 million job openings. Over the past 2 months, only 800,000 jobs added back. That's pretty bad. Is there a specific reason you point to as why those numbers aren't where we would frankly hope they would be?
It's a good question, and my thinking is that there are some temporary factors that are weighing on job creation, and I mentioned those earlier. Another thing is actual hiring is at very high levels, but it's being offset by high levels of quits and retirements. So what's happening is that the net job creation has been lower, but actual hiring is high. And that's, in a sense, quits is a good thing because people are looking for jobs that they want more. Retirements are just something that happens.
What about unemployment benefits? Does that factor in as well?
It may be a factor, and it'll be a temporary one because something like 15 million people will see either those benefits disappear or significantly decrease. In terms of things that are weighing on people getting in the labor force, I think it's those three things I mentioned. It's still some people are still afraid of COVID. Maybe they're living with someone who's vulnerable. It's also schools are closed still, and having schools be open again will free up a lot of caretakers. I think unemployment benefits too. I think if you would expect a really strong set of jobs numbers coming up beginning in the next month.
Chairman Powell, are you concerned from an economic and really a national security perspective about Russia and China dumping the dollar and what appears to be a move to some kind of financial alliance between the two of them?
That's not something that's really within our bailiwick or on our radar screen. The dollar is the world's reserve currency. There really is no currency that's close to being able to compete. That's because of our democratic institutions and our record of maintaining low inflation, and because we have open capital markets and are great traders with the rest of the world. I don't see anything changing in that.
Do you see the threat of raising the capital gains tax to 40% as a challenge to those capital markets?
And again, I really don't comment on tax and spending proposals. We don't have any authority over that. Whatever the level of capital gains tax is something that is the business of elected officials, not the business of the Fed.
I appreciate that. Over the past 10 years, the federal government's net interest costs have grown about 25% relative to GDP, despite the historically low interest rates. If spending remains on its current trajectory and interest rates reach their historic average of 5.7%, do you think the federal government will be able to pay its bills?
I have no question that the U.S. government will be able to pay its bills for the foreseeable future. There's no case in which that would not be the case. We have the strongest and largest and most flexible economy in the world. It's also true, though, that we're on an unsustainable path and that we're going to have to address that. And as I mentioned, the time to address that is when the economy is strong, unemployment is low, and economic activity is high.
Is it possible that the high interest rate that we're seeing today is the start of something that could be as bad as the 70s? And if not, could you explain why?
Very, very unlikely. What we're seeing now, we believe, is inflation in particular categories of goods and services that are being directly affected by this unique historical event that none of us has lived through before, called reopening the economy after closing it. So you see extremely strong demand for labor, for goods, for services, and you see the supply side caught a little bit flat-footed and trying to catch up. And you see bottlenecks and you see this all over the world, by the way. This is not just the United States. You see it everywhere, and it's very similar kinds of situations. And you have a central bank that's committed to price stability and has defined what price stability is and is strongly prepared to use its tools to keep us around 2% inflation. So all of those things suggest to me that an episode like what we saw in the 1970s, and I graduated from college in 1975. I had a front row seat. That nothing like that. I don't expect anything like that to happen.